Welcome to the weekly update, where I'll go over the action in the market for the week of March 20th through the 24th, and then we'll see how things look through the 31st. We had another up week overall, even though it was pretty rocky. We did finish on the positive side of things, and some of our charts are starting to show some improvement on a weekly basis. We're looking a lot more negative on a daily basis, but there's also some weakness coming through into our weekly charts that I'll go through. Then going back and briefly looking at each day, on Monday, bank stocks did bounce at first, but then First Republic Bank, which you probably have heard about in the news, it declined after its debt was downgraded. Then Jamie Dimon, who's the CEO of JP Morgan Chase, he was leading talks with executives from other banks that could involve converting the $30 billion that they're infusing into First Republic. They're trying to treat that as a capital infusion. They're changing the rules just a little bit to make it not look so bad. Then on Tuesday, the S&P closed above its 200-day moving average at 39.35 at that time. The Treasury Department is also looking for ways to implement some different rules without seeking congressional approval. Treasury Secretary Yellen came out and said, "We'll do what we need to do, especially with smaller institutions, to avoid a contagion." Then on Wednesday, the FOMC made their big announcement. That's when they raised interest rates, where stocks did initially go up, but then started to really decline. On Thursday, the S&P went above 4,000 briefly, but then selling resumed in the afternoon to take prices lower. On Friday, there was this news coming out of England about Deutsche Bank. This led European stocks a lot lower, and that initially influenced the open. But then right after the European markets closed, that's when we saw a nice bounce in the U.S. The S&P did fall below its 200-day moving average at 39.32 on Friday, but then rebounded above the 200-day moving average going into the close. So for the week, the S&P was up 1.39%, not gangbuster, but it was still positive on above average volume, so we're seeing volume picking up a bit. The technicals are kind of mixed right now, some negative, some positive, because of this whole inflation and interest rate scenario, and then the whole banking problem, which they're hoping won't develop into a contagion, where it starts in one place and then grows a little bit bigger. Eventually it affects the whole sector, then the whole country, then it goes global. They're really trying to avoid that from happening. Our trend is still weakening. We're below the moving average. We're below 20 on the weekly chart. We're also not trending on the daily charts as the markets are bouncing around. First area to look at, and I'm incorporating this from the supplemental video that I had been preparing. I'm bringing some of those charts into the other videos that I do. These are Isabel Net charts that were published on Saturday, March 25th. This just shows insider transactions. Now, these are legal insider transactions that happen. These could be CEOs or officers of a corporation. When they buy or sell, they have to report that. When this red line is dropping down, that tends to be more bullish. When it gets really high like this, that means there's too much going on in one direction, and we tend to use this as a contrary indicator. I'm not going to go through all of this chart. This just gives you historically what has happened, and when the Fed does go through the process of hiking rates, something usually breaks, and this is what has happened historically when we've seen other cycles with the Fed raising interest rates. This chart is just showing that money market funds are getting at a really high level. We're seeing interest rates going up, and so folks are taking their money out of their savings accounts and other things that aren't giving them really any interest at all and putting them into money markets, because even though they're below the rate of inflation, so they're losing money, it's a better return than what they've been seeing elsewhere. And now they're worried, is this going to be the next bubble? Another chart from Goldman Sachs suggests that S&P borrowing costs remain low. We're also seeing the employment situation remaining rather strong right now. This dark blue line just shows how initial jobless claims have really been declining. This is more of a sentiment chart for those that are expecting a stronger economy or a weaker economy. That has really been falling. We hit a low in July of 2022, bounced up off of that, but now we're starting to come back down. This chart measures commercial mortgage-backed securities. If you ever saw the movie or read the book, The Great Short, that's what really led to a lot of the financial crisis that we saw. And this is suggesting that their prices overall are the lowest that we've seen in quite a while, where we did really go down throughout the financial crisis, but then we hit bottom and started coming back up. We did go down a lot in 2022. We're bouncing back up a little bit more, but have we finished going down, or are we going to start to go back up? The next chart from Bank of America shows that there's a real bearish shift on banks. In March of 2023, there's not much of an overweight in bank stocks as people have been getting rid of those. This chart is from a while back, but this just suggests over the past 2 decades that stocks tend to bottom in March. I also bring up charts from a website called currentmarketvaluation.com. This is just a free site that you can go to and look at these charts. Are we overvalued or undervalued as a whole? Well, right now, they're considering us to be fairly valued when they take all of their indicators together. And here's a historical chart of how that has changed over a period of time. Now we go and look inside what makes up this aggregate score. The first thing we look at is called the Buffett indicator, where we compare stock prices with GDP. We're still below this 1 standard deviation. Another chart is the PE ratio model that they look at. We are overvalued since we're above this +1 standard deviation. We look at the interest rate model, considered to be fairly valued right now. Not too hot, not too cold. The S&P mean reversion model, this is the chart that I probably look at the most to consider if we're overvalued or undervalued. Then looking at some recession indicators, we have the yield curve model, and this is this way mainly because we have so many yield curves that are inverted. There are 16 states with decreasing SCI, and if a lot of states are having trouble, then the whole country might be in a recession at that point. We also look at the margin debt model, which is continuing to be neutral. Then we also look at the junk bond spread model, which is also considered to be neutral. Then another interesting website is called realinvestmentadvice.com. They have daily blog posts that they go through, and sometimes I include some of that information in the daily videos. Well, every week they have a newsletter that you can go to their website and look at, and I have some information from that site. Some of their indicators are now generating buy signals. They use a thing called the money flow index, which is an indicator I use, but looking over on the right-hand side, we're seeing a positive cross with this money flow indicator, with their stochastic indicator, another money flow indicator, and their MACD. So this is looking more positive, and we're seeing a little bit of that, especially the daily charts. Here's another chart showing that we do have some support down below at about the 3802 level. We've been bouncing up off of that. The thing to note on here is the MACD on the top, where we are starting to cross over positive. And then I'm not going to read all of this to you, but these are just some bullet points that they suggest, where they say at the top, with these buy signals in place, investors should modestly increase equity exposure. Now, you may not agree with that. This is just what this particular website is saying. And they think that the path for stock prices is going to be higher over the next couple of months. You could look at some other charts and come to the exact opposite conclusion. Another chart that they post that's kind of interesting is, what is the implied Fed funds target rate? When are they going to top out before they start lowering interest rates? And where this red circle is, that's where we're at right now. Here's another chart just suggesting on the bottom, these are money market assets where we're seeing a real drawdown in domestic bank deposits. At the very end of their post, they say what the Fed said. These are 3 bullet points just to give you an overview of what happened on Wednesday. The Fed did raise rates 25 basis points. We're now at 4.75% to 5%. They also said that the Fed will continue the same pace of reducing Treasury and mortgage-backed securities. The Fed is taking the stance that the U.S. banks are sound, they're resilient, but these events that have happened right now could weigh on growth. That means that they could feed into stock prices. Looking at the technical overbought, oversold composite, we're pretty much neutral. This chart just looks at sentiment. Then another site where I get all my charts from is stockcharts.com. They have a number of blog posts. There's a gentleman named Arthur Hill who sometimes posts some interesting things. So I have some of his charts to show you. He's making an interesting observation. What I've been pointing out in the daily videos is that the small caps have really been underperforming the large caps, and that could be positive because the big stocks are holding up better and eventually might be able to pull the small caps back up. He's suggesting just the opposite. He says that small caps are leading the way lower, and the breadth indicators are showing some serious deterioration that's happening under the surface. Large caps are holding up for now, which is what I've been seeing, but keep in mind that weakness in small caps foreshadowed the January 2022 peak. Here's a chart of the Russell 2000 small cap index, how we've been breaking down a little bit. The interesting thing is down here at the bottom. This is a proprietary indicator that he uses When we're above this line in green, that's positive. When we're below it in red, that's negative. We switched negative and have been going lower with small caps ever since. This is a chart that I have showing the micro cap index. These are the really small companies valued from 50 million up to 300 million. And noticing they just set a new 52-week low. So that could be negative on the market. Then another chart that he's showing shows that note at the small cap index peak, when it peaked in November of 2021, the SPY peaked 2 months after that. Even though I focus completely on the S&P 500 for all the strategies that I implement, I look at all of the other markets. Sometimes that can give us some clues. So I'll just keep watching this and reporting on it as I see different things, but this is just something to be aware of. Going into the charts that I show you, here's the intraday chart going back to Monday, where we had a positive day that day. We chopped around a little bit. Tuesday was more positive, where we gapped up, but then ended up going sideways for most of the day and then seeing some strength later in the day. Wednesday was when the Fed came out with their announcement. Things were really sleepy. Then you can see all this gyrating around. That's when the Fed came out with their announcement that they raised rates 25 basis points. We went all the way up to this resistance level and then started going down after that and just kept going down and down and down. On Thursday, we did gap up to lessen a little bit of those losses. We went right up to the 200-day moving average. We spent the rest of the day declining. Then on Friday, we were able to get back above the 200-day simple moving average, above the daily pivot, and close at the high. For the week, the Dow was up 1.2%, the Nasdaq up 1.7%, the S&P up 1.4%, and the Russell 2000 small caps were up 0.5%. Here's a look at the different indexes for the week. Now, these are just the last 5 trading days. This doesn't go from Friday to Friday, where the Nasdaq 100 and the Nasdaq did the best, followed by the S&P. We had the Dow, the NYSE, the mid caps, and the small caps ended up being down for the 5 trading days last week. This is going back to the beginning of the year, where the Nasdaq and Nasdaq 100 are doing the best, followed by the S&P, where all of the other indexes are now underwater. And then if you go back to the all-time high, all of the indexes are underwater, with the Nasdaq 100 and Nasdaq leading the way lower, but they are pairing a lot of those losses. Looking at the different sectors for the week, we had communication, energy, and materials were up anywhere from 2 to 3%. The weaker sectors were utilities and real estate. And then this is an RRG chart showing the relative rotation graph. Think back to your geometry class in high school or whenever you took geometry. The line going across is the x-axis. If we're on this side of the line, that's positive. If we're on the other side of the line, that's negative. Now, this line going up and down, that's the y-axis. Above the x-axis is positive, below the x-axis is negative. So if you're up here in this leading category, you have a plus X and a plus Y. If you're down below, you have a plus X and a minus Y. If you're over in the improving category, you have a minus X and a plus Y. And if you're at the lower end, you're at a minus X and a minus Y. What this measures is what are the different sectors doing. Right now, the 2 leading sectors, and it's kind of hard to read this, would be communication and tech, where they're getting stronger and stronger. The sector that is improving is the discretionary sector. It's been lagging a little bit now. You can see this little key I have over here on the side. Real estate had been doing some improving, but it's now showing some weakness, where we have all these other sectors are continuing to show a lot of weakness right now. Sometimes this can be helpful to get a graphical representation of what's happening inside of the different sectors. So this chart just goes back over the last week to see how the different sectors are performing, and sometimes we can get some clues from this. Looking at the different sectors for the week, communication and tech were up, with utilities and real estate being down the most. Going back to the beginning of the year, communication, tech, and discretionary are doing the best, where all the other sectors are now underwater, with energy leading the way lower, which was the real darling in 2022. Going back to the all-time high, energy is still in the lead, even though it's giving back a lot of those gains, where all of the other sectors remain underwater. Looking at sentiment, we're at 33 right now, in the fear area, but not showing extreme fear. And here's a chart where we had dropped down below the minus 25, which a lot of times will give good support to stocks, and we can bounce up out of that. Well, we did bounce a little bit, but now we're just kind of floundering around. Looking at the VIX, we showed for the week we did decline on the line chart, and we're also starting to come down on the bar chart. Here's the active asset managers. These are folks that professionally manage money on behalf of others, and they're just human beings, so they act with emotions too. Right now, they're pretty much neutral. The right X bear bull ratio, when this goes up, that means folks are getting into the bearish funds, which makes money when the market goes down. When this line is going down, folks are getting into the bullish funds, which make money when the market goes up. Now, this chart is not really helpful for two reasons. Number one, we tend to get this information late. It's delayed a day or two, so it doesn't really help us. And secondly, the folks that are involved in these kinds of mutual funds tend to react to what's happening in the market instead of doing things ahead of when it actually happens. Right now, we're pretty much neutral. We're at 0.08. We're not giving an extreme negative or positive reading. When I pay attention to this the most is when we get really, really low readings. People just think the market's just going to go up and up and up, and it's just a big cash machine. And then when we get really extreme negative, that's when people are panicking, and quite often that marks a bottom in the market. Also, another group that tends to react to what's already happened are the individual investors. They are still extremely pessimistic about what's happening in the market. The Ulcer Index is below the moving average, but slightly going up a little bit, showing that fear is not overly excessive. Then looking at the economy, and again, the problem with some of these charts is we have a delay in when we're getting the data. We can take data 2, 3, 4, 6 months after it happens and look back and go, oh yeah, that's what happened. We need to make decisions in real time. So some of these charts aren't as helpful as we would like them to be. If this line continues to go up, that means that there might be a problem in the economy. This measures the spread between risky loans and not as risky loans. And when this goes up, that means there's more fear. The next chart is just showing the National Financial Conditions Index. As long as we're below this black line, the conditions are remaining okay. This chart, which hasn't been updated now since the beginning of February, this shows how the tightening standards for banks has been increasing. Here's the real-time SOM Rule Recession Indicator, which isn't really all that real-time since the latest data I could find was on March 10th. As long as we're below this red line, that means that we're not necessarily headed into a recession, and we're even below the black line. Same thing is true with this chart, which is even older data. As long as we're below this red line, then it's not signaling the probabilities of a recession. And then the Bray-Butters-Kelly Leading Index, also outdated information. This is going up a little bit, and we're above the black line, so we want to keep an eye on that. And then looking at the liabilities and capital of the Fed, they had been humming along doing pretty good. When they're above this black line, that means they're making money, which they eventually then send over to the Treasury Department. Well, look at what's happening lately, where we have fallen off a cliff, and we're waiting to see what kind of fallout that may have in the markets. Looking at inflation, this is the inflation nowcasting. We're pretty much flat on the week. We're going to get the PCI report at the latter part of this upcoming week. And then another look at the Fed balance sheet shows how it's now starting to go back up. Depending on who you talk to, some people say, no, this isn't quantitative easing. We're just doing things in a little different way. Where other people are saying this is just QE by another name. And this is a look at that same chart where this chart has really spiked up lately. It's come down a little bit, but it's really spiking up from where it had been. Now, looking at the breadth, we're still hanging in there okay based on price, but we're looking a little more weak based on volume. We've fallen below the moving average. The advanced decline ratio turning back up slightly. With the 39-day exponential moving average, we are back above zero, and we're showing some improvement with the 19-day EMA. Looking at the new highs, new lows, we're not really seeing a breakout in new highs, but we are seeing a bit of an expansion of new lows. So our 4-week moving average is declining, as is our 10-week moving average. Accumulation distribution, this remains positive. We're still above this upward sloping moving average. So as long as we stay above that, that is more positive. Then looking at our trend where the ADX has fallen down well below 20, we're below the moving average. The red line is on top, so we default to negative. We're also seeing pretty much the same thing on the daily charts. The Arun, which tries to measure buyers against sellers, this tends to be positive overall, where it's negative on the daily chart. The mass index is not generating a signal right now. Then looking at the daily chart, we're still above this downward sloping trend line, and that's good. We're also still above the 200-day simple moving average, which is also good. Can both of these levels hold if we continue to fall? Are we going to be able to bounce up and go higher? Will we break back through the 50-period moving average and get above this monthly pivot line? We're still at pretty much the center point with our trend channel going back to 2009. And looking at the monthly pivots, we are below for the S&P. Can we break back above that, as I was showing on the other chart? We're also a little bit above the 50-period moving average by 4 points, so that is slightly positive. In our long-term trend, we're trying to generate a golden cross here on the weekly chart. We already have one on the daily chart, but we haven't quite done that yet on the weekly chart. The bullish percent index, this is almost identical to the daily chart. After going extreme negative and bouncing back up, we are showing some improvement, so that potentially could be positive. Chaikin oscillator is above the dashed line. That's positive, but we are still declining, so that's showing weakness. And the Chaikin money flow is also positive, but showing a little bit of weakness. The force index, more positive. It came back above the zero line. McClellan oscillator just barely above the zero line, so that's turning slightly positive. And then our summation index based on price and volume, they're still negative, where we're going lower based on price. But if you look at the bottom, we're starting to turn up based on volume, and we're seeing that same thing on the daily chart. The different oscillators, I don't really like oscillators on a weekly basis. I know some people disagree with that. We're looking positive on the daily chart. We're negative with slope on the weekly chart. The TSI is also rolling over, which is turning positive in the daily chart. The MACD is turning positive, but turning negative here. The PMO and the PPO still continue to be negative. And longer term, we have the TRIX and the KST, which are rolling over a little bit, but are still positive. So we're seeing a real mixed message between the daily charts and the weekly charts. Swollen trading oscillator, based on price and volume, is showing some improvement. We're above zero with both. And here's the PMO study, where it's going up, rolling over a little bit, showing a little bit of improvement, but is still negative based on price as well as volume. The PMO study, showing some improvement with the PMOs that are rising, also with the number of buy signals, but we're still declining with the PMOs that are above zero. The RSI is just a tick under 50, above 50 positive, below 50 negative. The special K is still positive, even though it's showing some weakness. It's still above this moving average. This is a very long-term oscillator to determine the long-term trend. The Stochk RSI, after giving us an extreme negative reading, has been bouncing, so that's showing some improvement. And the Williams percent R never went extreme negative, but is also showing some improvement. The Vortex is kind of mangled up right now. It doesn't know whether it wants the red line on top or the green line, so we're a little bit mixed right there. The ultimate oscillator is more negative. We're below 50 and declining. The money flow indicator, which I alluded to with the real investment advice charts, I tend to use this when we're getting extreme positive or negative readings. We're also negative here, even though we're showing some improvement since we're below 50. The percent B, how far away are we from the upper or lower Bollinger Bands? We're pretty much at neutral. And going back 1 week, the rate of change was positive since we saw a slight up week. Going back 50 weeks, we are showing some improvement. The Copic curve is giving us a buy signal on the daily chart while we're still descending on the weekly chart. And here's a look at our fib levels longer term, where support is holding at this 38.2% retracement. Can we stay above that and then eventually get back above both of these moving averages? Looking at our different charts, the Heikin Ashi is now looking more positive with an open candle. The Kegi chart has a black line that's going up. That's positive. The Renko has open blocks. That's positive. The ease of movement, this is kind of strange. Going back 1 week, that's kind of a weird reading to go up so much on a week that didn't see that much of a change. Looking at the 14 period ease of movement, we're getting back to neutral. And the point and figure chart did not generate a new signal, but we added 3 new X's over this past week. The 3-line break is continuing to be positive with open bars. Looking at the Elder Impulse system for the S&P, we are negative with red bars. We're also negative with the parabolic SAR. We switched to positive on the daily chart. We're still negative on the weekly chart. Then some broad market looks. Here's the S&P, the mid caps, and then the small caps. Mid caps and small caps have been showing greater weakness as of late. All stocks. Then you're going to hear a broken record here. Recent golden cross, weakness, trying to bounce back up. Mid caps, recent golden cross, weakness, trying to get some bounce underway. And the same thing is true with the small caps. The Dow, also recent golden cross, and then weakness, trying to get some recuperation going on. The NASDAQ has actually been holding up a lot better. We haven't reached the golden cross yet on the weekly chart, where we have on the daily chart. And the same thing is true with the NASDAQ 100. The Wilshire, which is a broad measure, trying to give us a golden cross, but not quite yet. And the NYSE did give us a golden cross and then some weakness. The FANG stocks, recent golden cross, and are starting to break out a little bit to the upside, whereas ARK is still in an overall downtrend and far away from giving a golden cross. Looking at the biggest software companies, trying to generate an overall golden cross here. We have seen that on the daily chart. We're waiting for that on the weekly chart. And then looking at the bank index, showing a lot of weakness here right now. This is a daily chart where the RSI has gone extreme negative and the MACD is just looking like it's falling off a cliff. Looking at Dow theory, I tend to include utilities in this overall look where the Dow's been holding up, but we're seeing a little bit more weakness in the transports. And we're also seeing some pretty significant weakness in the utilities. And then some broad market measures, the CRB index, recent death cross, and has been declining even though it bounced back up this past week. Copper, which tries to give a look at the economy, still in an overall uptrend, but has really been going sideways lately. Gold, which everybody's convinced should be at the moon by now, is starting to break out a little bit, but we still have some pretty significant overhead resistance before we get set to go higher. And the same thing is true with silver. Oil dropping down below 70. We're currently at 69.26. The dollar was down slightly on the week. Then looking at bonds, which have been doing quite well lately, we're not quite at a golden cross with our ETF. Here's a daily look at the yields, how they've been coming down. And then we look at the MOVE index, which just measures the volatility of bonds. It's been picking back up as of late. And here's a weekly chart showing how the US, the UK, and German rates have been coming down overall. Japan's its own little story that we're keeping an eye on. Some relative studies. Here's our intermarket analysis chart. Oil is still in the lead, followed by the dollar and then gold, where stocks and bonds continue to be negative. The bond to S&P ratio is starting to break out a little bit, but we're not seeing a cross yet in the ratio. The stock to bond monthly chart is showing how stocks have really been underperforming bonds, but are still in an overall long-term uptrend. Gold to the US dollar. Gold is doing well as the dollar's been showing some weakness, so this ratio is going up. And gold is doing quite well against the S&P, so the ratio continues to advance. Low volatility stocks, which were the place to be in 2022, are now starting to see some weakness. And the growth to value ratio, showing a lot of improvement here, but still in an overall downtrend. And then the NASDAQ 100 to the S&P, still in a downtrend, but really have been holding up a lot better as of late. And the 100 stocks in the S&P have been really outperforming the rest of the stocks in the S&P 500, but are still in an overall downtrend. And discretionary has been underperforming staples. Energy, which had been really outperforming tech, is now showing some weakness as tech is starting to show some improvement. Then looking at some of our cyclical studies, this goes back to the October 2022 low, where we set a low. And if you look at other times when we had this same reading, that marked a significant bottom in the market. Well, we shot up out of that, and 2023 was looking really good, but now we're starting to come back down. But please keep in mind, I don't have the note attached to this chart. Looking at 1, 2, and 3 years from the time this signal was generated, it has a perfect track record, but it might be a nightmare getting from point A to point B. This is another thing that we're looking at. We're trying to determine if that breakout above the trend line that we're seeing, is that true or is that not true? When we go back to 1998 to 2004, the market was trying to break out above this downward sloping trend line. It did it once, and then it did it twice. But look at what the MACD was doing during that time. It was not really showing all that much improvement and never got above zero. We saw the same thing from 2007 to 2010. It looked like we were breaking out above this downward sloping trend line, but look at what the MACD was doing. Now we project to right now. We were looking really good with this. As we were breaking out above this trend line, the MACD was looking pretty strong, but as we're falling back, the MACD is starting to roll over. And I am going over this chart every day right now in the daily videos. But so far, on a positive side, we're still above this downward sloping trend line, and that could help the MACD do a little bit better, especially if we start to go higher. If we drop down below this trend line, that would be negative, and if we see this MACD really start to disintegrate, that could suggest that this breakout has in fact turned into a fake out. What's our outlook for the upcoming week? Here's all the different economic reports that will be released. I'm not going to read all these off to you. The big ones will be on Friday with the PCE prices. That report goes more hand in hand with CPI. And then we have consumer sentiment. I tend to think that's a pretty big one. So the technicals are kind of mixed right now. We have some positive, some negative. The daily charts are more negative but showing improvement because of this whole inflation and interest rate scenario. We'll see if we get any more Fed speak. There are some speeches coming up that I'll show you. But the markets are really worried about this whole banking problem and if that's going to lead to even bigger things. Here's the Fed speak. Again, I won't read this off to you. The thing to really note on this is that Fed Chair Powell is not any of the people that will be giving some speeches in the upcoming week. He's the most important one to pay attention to. Other ones, they like their time in the spotlight and they'll give interviews and they'll go on the different financial channels. But it's when Fed Chair Powell speaks, that's what we really have to pay attention to. And then looking at the Stock Traders Almanac for Monday, we tend to be fairly positive. The Dow is up 61.9% of the time. The S&P is up 57.1% of the time. The Nasdaq's up 66.7% of the time. And then these other areas, which will go away by the time you see the next weekly video. So I'll revamp this whole slide in the upcoming week. These add more to the positive backdrop that we're not really seeing yet follow through based on price. Here's a chart showing that on Monday, we will be at the 19th trading day of the month, and during a presidential cycle, that tends to be more negative, which is contradicting what we just saw, where overall, the S&P tends to be up when you take all the days into consideration. We're also at that point in the pre-election cycle after we had the midterm bear market where we should be following this gray line right now, but we just haven't been doing that very well. And then if you follow along with Stock Traders Almanac, we should be in that sweet spot where at the beginning of the sweet spot up to the end of it, the S&P returns 20%. We got a long ways to go in just a few days if that's going to happen. Our scenarios, this is based just for Monday. We can't really go with the down scenario even though our charts are mostly negative. We're not trending right now, and the technicals are showing some improvement, but we can't really go with the up scenario, again, because we're not trending, even though things are looking a little better. So for Monday's session, we're still going with the sideways trend because the ADX is weakening, it's below 20, and it's also negative. Then another little graphic that I got from Earnings Beats, which you can easily subscribe to their email and get this same thing for the month of March. The sector that tends to be hot are utilities. Hasn't really done all that well. But look at this one. The financials are the ones that's not hot. And this was sent out before we started getting all this banking mess. We're coming into the latter part of the month where overall we tend to be more negative to slightly neutral. Thank you. I hope you found this helpful. I hope the extra information is useful to you. I'm one of these free thinkers where I like to take as much information as I can and then reach my own conclusions based on that, and I hope you do the same as well. Please also check out the intermarket analysis video as well as the deep dive video where I go through different charts that I didn't really talk about in the daily videos. I hope you have a really nice weekend, and I will talk to you in the next video.